to thank you for inviting us to be part of your Digital Transformation Thursdays. The truth is, and I'll get to that in a bit, we actually do want to reach out to the FinTech community, and we've been trying to do that. And we also want to reach out to the legal community that's knowledgeable about FinTech. And that's not a particularly large community, because we think this really has to be done in coordination and cooperation with the private sector. As you'll see, hopefully through this presentation, the SEC is still trying to develop its own sandbox approach to analyzing FinTech. In principle, we have adopted the sandbox approach, and we have a view of, we have a desire to apply the sandbox approach in order to test new technologies. But in practice, translating that into an actual framework for vetting a FinTech is a separate matter. So we know what we want to do in principle, but being able to do it is another thing. So we thank you for the opportunity to speak to you and the community behind FinTech. Now, you posed a very good question to me. I don't know if you want to do it now, so you can do it in your own words, but I thought it was a really good way to start this off.
All right. So the question that I posed to you was, I think increasingly, if we're looking at what do you call this? We're looking at the future. The future looks like it's going to involve digital assets, which were designed specifically to remove as many intermediaries as possible. And I think the question now is, the SEC, I think the history of the Securities and Exchange Commission is precisely in regulating those intermediaries. I think prior to that, the stock market was unregulated. I think famously after that, was it Papa Joe Kennedy, I think, was the first Securities and Exchange Commission. And I think I believe there was it Roosevelt or somebody had said, yeah, he knows all of the tricks. So he should be the one. He knows how to regulate this market. And my understanding of the way SEC regulates is that it regulates it by licensing the intermediaries. And there are many, the brokers, the broker-dealers, and the exchanges, and also the issuers of the securities.
Right.
So in a world where increasingly that will be disrupted, what role do you think the Securities and Exchange Commission will have?
Yeah, I think that's a great question. Partly because, well, let me first start with our standard disclaimer in our presentations, which is like, for purposes of this webinar, these will be my own personal views and not necessarily those of the Commission as a whole or our staff as a whole. And that really allows me to speak more freely with you and your audience about what we think and our approach, or at least my view of what our approach should be towards this FinTech and this disintermediation trend that you've pointed out, which is a correct point of view, I believe. And really, our basic approach to FinTech is what I've put out now on our slide, which is that the technology may change, but the concerns that we're trying to address through regulation doesn't really change. The approach by which those concerns are addressed may change because of the technology. And in fact, as you pointed out, when the US SEC was first created, 33-34, and when the Philippine SEC was created just very shortly after the US SEC, since then, from then until now, there have been actually technological changes which have affected the way we regulate. But the underlying concerns, which I put out here, transparency, disclosure, fairness in dealing with investors, suitability of investment to the investors, fiduciary responsibility of people who are entrusted with investor money, and the more modern concerns like anti-money laundering and know your customer. These concerns have not changed. So our approach is like, okay, the FinTech, it promises a new way to address persisting concerns. That's our approach. And in fact, if you think about it, FinTech has already done that. Even before it was called FinTech, technology has already affected the way we regulate. In 33 and 34, everything was paper-based. So really, a share of stock was on a piece of paper that evidenced your ownership in a corporation, or a bond, or a certificate of indebtedness, or some other promissory note would be on a piece of paper, and that would evidence indebtedness. And you had one of our key concerns in securities regulations to make sure that payment and transfer of ownership of these securities happen at the same time. The technical term is delivery versus payment occurs at the same time. In Filipino, we have the perfect term. It's called kaliwaan. When I pay you my money, I get my proof of investment in your company, whether it is a bond or debt, evidence of indebtedness, or a share of stock. And once upon a time, that was all paper. And in the 90s and 2000s, we moved from paper to dematerialized securities. So even today, we didn't call it FinTech, but no security is in paper format anymore. Everything is lodged in a centralized database that is in the Central Securities Depository. And that facilitates faster trading and faster delivery versus payment, or kaliwaan. Now we can, on the bond exchange, within 1 day, effect kaliwaan of payment. And on the equity exchange, the convention is 3 days later, magkakaroon ng kaliwaan. Although technologically you can actually be faster now, but we still use the convention of 3 days, and that's very different from when everything was paper and you had to mail your certificate of your security to the other party, and the broker would have to wait for it. The broker would get your check, and the check would clear in the bank, but the broker would wait for that, and they got the piece of paper in evidencing the security. So all of that has already changed. FinTech that's coming up, and you're highlighting this in your webinar, promises to revolutionize further some of these mechanisms by not having a centralized ledger or record, or in current terms, a centralized securities depository, but possibly a distributed ledger where the safety and security of the recording is no longer necessarily based on the systems of a particular intermediary, as you pointed out, which is the Central Securities Depository, as the repository of all securities, and the transactions are on the trading engine. But the blockchain itself, distributed among a group of users, has the record, and then you have a distributed ledger instead of a centralized ledger. So that's among the FinTech that's coming up. So that's a long way of saying SEC very open to FinTech, because we think FinTech has enhanced, like in the case of the use of a Central Securities Depository and delivery versus payment mechanisms, it has enhanced and improved securities concerns coming from the paper-based system to the electronic system. And there's the possibility that new FinTech will further enhance and further make efficient securities transactions and securities regulation. So our approach is really, okay, each new FinTech, we have to try to figure out how it fits in the overall scheme of things. So there's no one-size-fits-all approach to FinTech. And we will admit that we're really coming off from our understanding of traditional structure. So part of the challenge to the SEC is the rules were really written when everything was on paper. And it's easier to imagine how the rules will operate in a paper-based world. But having said that, we're really not in a paper-based world today. So even today, we've moved to electronic, and that makes things a little more difficult, particularly for the legal community, to imagine how these transactions are taking place. But our understanding of the traditional method informs the way that we evaluate the FinTech, because that's where we're coming from. And then there was a concern, I think you also brought that out before, that part of the goal of disintermediation, so we're not against disintermediation, particularly if it improves efficiency and protects investors by removing some of the risks inherent in the current system, where you can think of an intermediary as a middleman. Bibigay mo muna yung pera mo to the middleman, or your property or your security sa middleman. And so there is a risk that something may go wrong while it's in the hands of the middleman. No. So to the extent that fintechs reduce that risk, we're very open. But there was a perception early on that maybe fintech will render regulation obsolete, no, or like take it out of the ambit of regulation. And our view is that's not really going to happen, because even though the way you do something is different, the essential nature of the transaction has not changed. So our approach to regulation is not really entity-based. No? Just because, let's say, you replace the stock exchange system and having a group of brokers acting as an intermediary with a platform where the program acts as the intermediary to match the investors with the investees, the borrowers with the lenders, the companies, investors. Just because you change the matching system from a group of entities and companies and people to a system doesn't really change the activity. You're still trying to match investors and companies, borrowers and lenders. So from an activity approach, the activity hasn't changed. The underlying essence of the activity hasn't changed, but the mechanics may have changed. So that's why we think we will continue to retain our jurisdiction, even as fintechs alter the way we do trading and, let's say, disclosure about securities. But they might do it in different ways, and it may change. It may change the entities that are part of that transaction. But we're open to that. We're open to that, and we don't. And evaluating these technologies, we don't particularly favor any. We try to be as neutral as possible, because you can never tell. One of the ongoing debates, for example, that we know is going on in the financial industry and the IT industry is a distributed ledger really superior and more efficient to a centralized database? That's one of the questions that's being raised right now, debated on. Is the current messaging system for interbank instructions, which is usually done through the SWIFT mechanism, is that necessarily more expensive or less effective than a distributed ledger tokenized mechanism of sending messages? So we don't take a particular side. We try to find out, okay, looking at the technology, does it address our concerns? Does it protect investors? Is the transaction properly recorded? Does it facilitate information exchange and disclosure? Is there central trade reporting? Can we audit the transaction to make sure no one has taken advantage of anyone? Then if the technology, whether present or future, does that, in theory, we should be okay. We should be okay. Okay, so our challenge is then balancing this new technology and the opportunities of the new technology with the current system. Now, naturally, we are more familiar with the current system. So as I said, we are in principle, we're technology agnostic. But the reality is we're kind of aware, we're more familiar with the current system. That doesn't mean we prefer the current system because we know the current system has its own flaws. No? Yun nga, dadaan ka pa sa third party. What if the third party or intermediary or middleman, what if something goes wrong with his records? Diba? But we know this system because it's the system that we have today. But we also know that this system, the current system, could be improved. Now, whenever a fintech comes over and promises improvements, of course, we're interested, no? But then we are also duty bound to check, wait, does the improvement carry with it other concerns? Like on a distributed ledger and blockchain, for example, I'm sure you've heard it, and again, I don't pretend to be an IT expert. There are issues about scalability. And what that really means for us as a regulator is, okay, wait, this is good for like a situation where you have maybe 5 transactions a minute and maybe 100 transactions a day. But let's say you have a system that's going with thousands of transactions in a day, with hundreds of transactions. Can the distributed ledger keep up, and will it slow down and cause a backing up or non performance of trading transactions? Can it take the load? And that's a concern. Again, that's a technology agnostic concern because we've seen current systems slow down when there's huge demand, transactions demand. So you try to check as well when you look at a new fintech proposal. Wait, are there cybersecurity issues? My joke used to be, because the SEC itself is going on into its own IT transformation where we're moving our records. We're still in the process of digitizing our records. And then my joke used to be, well, in terms of cybersecurity, the old system was super cyber secure because it was all paper. And being all paper, it was unhackable. But then since it was all paper, it's so difficult to retrieve useful information from our database. So when you go to a digital form or a different IT form, the question becomes, wait, now I am hackable because it's all digital. Can it be altered? Then what do I have to do to protect myself from the new risks that I didn't have with the old system? So this is again, overall, what we try to do with FinTech. And in terms of distributed ledger technology, we're not the only ones who are interested. So there is actually a working group and the Insurance Commission trying to understand, okay, how will distributed ledger technology, which is, I think, the new neutral term, because before, if you said blockchain, everybody said Bitcoin, and then that seemed to narrow the application. Like, okay, Bitcoin is just a use case or example of how to use distributed ledger technology, but there are other ways to use it. And for example, the BSP, I think, is a leader in the sense that they've already allowed tokenized transmission of currencies or payments through money service entities, so licensed, essentially money changers, and remittance businesses. So that's something they're working on. What we're looking at is the possibility of distributed ledger technology affecting securities transactions. So you'll see at the bottom of this slide, we think DLT is the technology trend that may underpin a number of new trends, and the use case that might be most pertinent to the SEC would be security tokens. We wouldn't be interested in utility tokens where the tokens are being used to effect some kind of other transaction or record keeping or payment, but security tokens where the tokens evidence either an indebtedness or an equity investment in something, a loan, some kind of investment contract, asset-backed, a token that represents some kind of financial asset. Those things are probably the ones that the SEC will be most concerned about, and for that, we're thinking about how they could contribute to what we think of as a digital asset exchange. Now, this slide just again tries to illustrate our approach, which is like, this is the traditional structure. So if you look at this slide, there's an investor, there's a buying investor, there's a selling investor, let's say on an equity market, and then there are these intermediaries that you see in the middle. Each one speaks to a separate broker. They deal with an exchange within the middleman, within the middle. And aside from the exchange, there are other intermediaries like a settlement bank for the cash side of the transaction, and then the depository for the security side of the transaction. So again, our concern usually is to make sure that when the trade is effected, it's done on a first come first served basis. So walang unahan, diba? If I'm the first, if someone's offering for sale a security at 100 and I raise my hand first digitally, I should be matched with that transaction first, and then magkakaroon nga ng kaliwaan currently through these entities. Now, the promise of FinTech is, okay, maybe we can eliminate some of these entities. Now, these intermediaries perform certain functions. For example, the settlement bank is the one that handles the flow of payment or the money, and then the depository is the one that maintains the record of securities, and the clearing agency is the one that ensures delivery versus payment or kaliwaan. Now, maybe a platform can combine some of these entities. Maybe a platform can remove the need for separate brokerages. The platform itself, through its own algorithms and programs, are the ones that matches the investor, the buying investor to the selling investor. Okay, so but when we get a proposal, and so on the right hand side you'll see, and I'll discuss a little bit more, a certain use case like for record keeping. We think of the traditional structure, but then we think, okay, what functions of the traditional structure will now be performed by the FinTech? How does the FinTech ensure that the risks are no worse or not much more than the current system, and how does it ensure that it doesn't add more risks that are unacceptable or risks that are not controlled in the system? So again, this is all like a very theoretical approach, but the reality is we've actually now moved along. Now we have crowdfunding rules that have already been finalized, and we have prototype rules for digital asset offerings and digital asset exchanges, which really go together. So that these are the alternatives to issuing a security. So now you issue a digital asset instead of a security, and then you, instead of trading in a traditional exchange, trading through a digital asset exchange. Those two other rules are still in the development stage, but we're nearing the end. But we've used, and I'm happy that PDAX is your other guest for this webinar, because they've been involved in an actual system that we have supported, that was and I'll talk about that in a little while. That was really triggered by the Bureau of Treasury, where their system and their online app was part of the mechanism for the distribution of the recently completed retail treasury bonds. We also, as I mentioned, our crowdfunding rules have gone out, and we are very close to approving the first crowdfunding FinTech in the Philippines, which will be some kind of debt market matching FinTech, or something like Lending Tree in the United States, where it's a peer-to-peer lending platform. Okay. So I think the case of bonds.ph, which was an app. I think most people know it. Most people know of it more as an app. That was really something that was done by Union Bank in cooperation with PDAX. Is an example of a use case where FinTech can address a concern with the current system, and we're trying to do it in bits, right? So in the case of bonds.ph, the concern with the current system is when you subscribe to, or you try to buy into a retail treasury bond of the BTR, normally you have to go to one of the banks, and then you have to go to your branch and apply and fill out a paper form and do your KYC, and it has to be transmitted. So it's a very paper-based system, and a very face-to-face transaction system. So you have to go to the branch to apply. You have to go to the branch of one of the banks that is a government securities eligible dealer. And you can see already that during a time of COVID pandemic, where various parts of the country are on various various levels of quarantine, and really, who wants to go to physically go to a bank and sit down for 2 hours to fill up a paper form? This paper-based mechanism of onboarding, or using going through the know your customer process, identifying yourself as a subscriber for a retail treasury bond, and filling up the form essentially to make order of the retail treasury bond. The current system is not the best, obviously, especially in a COVID-19 world. So the question then came, okay, could you do it via an app? Could we reach more people? And for example, there's so many people who are unbanked, so many people who have money to invest, but especially if you're in the provinces, I'm actually a provinciano myself. If people, I come from Zamboanga del Norte, if you want to go to the banks, you have to go to the capital city of Dipolog. In order, what if you're a trader coming from one of our southern towns of Liloy or Sindangan, or one of our northern towns like the twin city of Dapitan, but the Land Bank branch, for example, or the Metro Bank, or even the Union Bank branch is in Dipolog. So you have to go all the way to Dipolog, go into this. So the idea here is, like, why don't we just do it on an app? Why don't we just do it on an app? So Union Bank made use of the PDAX technology in order to take the subscription onboarding KYC process and make it digital, and use an online app. And this was something that was supported by the Bureau of Treasury. And the question then became, would that be a permissible way for Union Bank to distribute an RTB? Okay. So our approach, we try to put into practice the approach that I tried to outline earlier. Okay. So in this case, Union Bank making use of a distributed ledger technology, which I think PDAX can discuss better than me, at an online app in order to obtain customer information, know your customer information, and the order information from the various customers, and also inform the customers that yes, successful your so the app does know your customer, takes the order, you can put money in through the app, and the app informs you if yes, now there are retail treasury bonds lodged in the central record of the treasury in your name. So we're just using the app as a means of transacting with the investors. And when we analyze the process, and this is kind of like the rough idea of the process, okay, Union does not do anything more than it's already allowed to do or licensed to do. It just does it in a different way. Instead of issuing paper forms and taking the orders through the branches, they go through an app that they vetted, right? And we vetted, and they are entirely responsible for the outcome of the app. So from our point of view, there's no increased liability or increased risk. Everything is still the same. All responsibility is still borne by Union. As far as the investor is concerned, he's transacting with Union Bank just as he would if he walked into a branch, except that he's doing it now through the use of new mobile technology. So we said go, and I think it's better for PDAX to discuss how the details of how it went, but generally I can say BTR is very happy. They've reached more people, more Filipinos in more countries than they ever did before with their attempts at retail distribution. And they're seriously considering using the same platform or a similar platform again going forward. And we think we're still doing our post audit of the order taking through the Banks.ph app, but so far looks like it performed the way it was designed to perform. The question now becomes, okay, can we scale it up? Can we get even more orders through this mechanism? And I think this kind of illustrates an application of the framework that I tried to outline earlier on a more concrete level. Now, part of the challenge here really is, again, we want to go incremental. So this was very, Union and PDAX were very cooperative in our request that they go on an incremental level. Instead of immediately disintermediating all of the banks, all of the mechanisms in the traditional system, they just concentrated on one area first. And so it's easier for us to say yes, easier for us to audit. And if the experience is successful, which it seems to be, then even we become more aggressive and okay, let's see what else we can do. And I think this is the beginning of a concrete application by the SEC of this sandbox approach. Like, let's test it in this area first. All the other elements of a retail treasury bond issuance is the same. So the record keeping is still within Treasury. There are still custodian banks that hold the securities for the investors. But let's test this area first. And as we become more confident with the technology, then we become more open to additional use cases of the technology. So that's one very concrete area where I think we've made progress on really implementing FinTech. And the other one that we're hoping to do soon, so I can't really say I can't really say for sure yet because it still needs to be brought up to the commission for approval, is crowdfunding. And I think most people, I think, have some rough idea of crowdfunding. People have heard of Patreon or GoFundMe in the States. But in the Philippines, we don't intend to regulate. So again, activities-based. Just because it says crowdfunding doesn't necessarily mean that the SEC has to regulate it. If the crowdfunding is really a way to obtain or source donations, may drive, for example, for COVID response, or Red Cross has some drive and they want to use an app, that's donation. We don't regulate that. Okay. If crowdfunding is really, you're looking to solicit, let's say, for example, patrons to support you in your production of artwork or music. I think many of us will have seen that artists who cannot perform concerts now are doing it online, and then they receive voluntary payments through Patreon or similar. That's not us. That's an investment. What we do is on the right side of the slide, which is if the crowdfunding is to match borrowers and lenders, or if the crowdfunding is to get investors, okay, however you want to call them, whether they're stockholders or they're not stockholders, supporters, whatever, but they're promised a return. If you're promising a return on your investment, so soli ko po yung pera, tapos kikita ka pa. Okay, whether that's a promise like a debt, or it's a more equity-based na, okay, kung magiging okay yung negosyo ko, hahatian kita dun sa kita. Okay, so that's, may hati sa kita, equity-based crowdfunding, then the SEC will have to come in because that's within our jurisdiction. So that's how we think of crowdfunding. Again, it's activity-based. Does the activity fall under investment? Okay. And the thing that we're looking at now that is nearing completion, again, I don't want to talk about it in depth because we haven't got to it, is this peer-to-peer lending app called Investry Philippines, where they're trying to facilitate through an electronic platform funding through debt-based funding. And we're particularly interested because they're targeting MSMEs. And again, in this time of COVID, where we anticipate it will get harder for medium, small, and micro enterprises to obtain financing through a loan from a bank. This might be a way to facilitate funding of MSMEs. But we do have to vet very carefully to make sure that people know the risks that they're taking, or at least the risks that people take are limited and mitigated when they go to this platform. Pag nagpapautang po tayo, we're not always sure na masasoli sa atin yung pera with interest. So there we take an investment risk, and we just want to make sure that people are aware and are able to mitigate their risk. But we also see the potential, lalo na ngayon, na it's hard to go to the bank, make an application, fill up a form. Maybe this is a mechanism where people who have some savings can support other people who are transitioning from one work, marami tayo ngayon na work from or starting up a home. Many in our neighborhoods biglang naging bakers, diba? Or gumagawa ng pagkain, masarap magluto, diba? And are supplementing their income. Maybe this can be a mechanism. But again, we just want to make sure that people are protected as much as we can protect them, or at least they are aware of the risk. And we're hoping to see the launch or to have this implemented sooner rather than later. There's some other areas that we're looking at. These are more these are more technical sounding, but real. In fact, I had a question from an investment bank a few days ago about direct market access, and this is essentially, what if we cut out the underwriter? You know, what if somebody just listed on the stock exchange and then direction now using an app, and this has been done in other countries. No, what if we solicit the investments through the online platform, going beyond bonds.ph na may banko pang intermediary. No? Now, what if we remove the intermediary and go for a direct listing? So that's something that we will have to think about very carefully. Again, the idea is to make sure that it's not unduly more risky than the current system. But it in theory, makes things easier for people who starting a business to raise money without having to pay the fees of the underwriter, the account, well, maybe the accountant they still have to pay, and of course the lawyer. so maybe it can make those costs lower. And then the other thing that we've already actually started to do is simplified KYC for low-risk accounts. So making the onboarding process as easy as the payment apps that people have gotten used to during this quarantine period and pandemic. I think the observation has been that a lot of people have now become users of electronic payment systems like PayMaya or GCash or others, and the onboarding process so if you can go on those systems and order a coffee or pay for groceries or maybe you can also make an investment through those systems, and we shouldn't make the KYC process any harder than it is for setting up for low risk accounts. So those are other areas that we're actively working on, and that kind of like I hope that kind of illustrates that we are trying to walk the talk in terms of not just saying that we welcome fintech. We're trying to actually make fintech work for the investors and for the general public, but also still acting as a regulator, mitigate the risk and protect the people in the system. Hopefully this was informative. And then JJ, if you have any questions, I know unfortunately I can't be there live for the webinar on Thursday, but if you have any questions, I'd be happy to take them.
Well,